You did everything you were supposed to. For decades, you diligently saved in your 401k, believing you were building a solid nest egg for retirement. You trusted the system. You followed all the rules, you sacrificed and put off today's wants for the promise of a secure tomorrow. But what if I told you that by following the conventional wisdom, you've actually armed a ticking time bomb, a bomb that's set to detonate the moment you need that money the most? Most people think a market crash is the biggest threat to their retirement. It's not. There's a much bigger hidden danger that could cripple your financial future, and it works silently just beneath the surface of your account statements. The financial industry loves to talk about accumulation, getting your balance as high as possible, but they get awfully quiet when it comes to the trap that's set for you during the most critical phase of your financial life, the transition into retirement. In this video, I'm going to show you exactly what that danger is, reveal the four fuses that lead to the bomb, and most importantly, show you how to disarm it before it's too late. Here's the core of the problem. The rules that helped you build your wealth are not the same rules that will help you protect it and turn it into income for life. In fact, following the same old advice can lead to devastating losses. The entire retirement saving model is built on accumulating assets over 30 or 40 years. During that time, market downturns are actually your friend. They let you buy more shares at lower prices, a concept called dollar cost averaging. You get that little dopamine hit seeing your automatic contributions buy more when the market is on sale. But the moment you stop contributing and start withdrawing, that whole dynamic flips on its head. The game changes, and the rules you mastered are now used against you. This transition happens during what financial researchers call the fragile decade. The 5 years before you retire and the 5 years after this 10-year window is when your life savings are most vulnerable. A mistake here isn't just a temporary setback, it can be a permanent, unrecoverable blow to your financial security. The bomb isn't the market crash itself, it's the crash combined with other hidden threats hardwired into the 401k system. Today, we're going to expose them one by one. The single greatest threat to your retirement, the one that makes this a ticking time bomb, is something called sequence of returns risk. It sounds complicated, but the idea is terrifyingly simple. It's not that the market goes up or down that matters most. It's when it goes up or down relative to when you start taking money out. Let me tell you a story about two retirees. We'll call them both Jane. Both Janes worked their entire lives, did everything right, and each retired with an identical $1 million portfolio. They both plan to withdraw 4% a year or $40,000 to live on. The only difference is when they retired. Jane 1 retires, and in her first year, the market has a great run with a 10% gain. Her $1 million grows to $1.1 million. She takes out her $40,000 and is left with a healthy $1,060,000. Her portfolio is bigger than when she started. Even after taking income, she's feeling fantastic. Now let's look at Jane 2. She retires with the same $1 million, but in her first year, the market crashes and falls 30%, a lot like what retirees saw back in 2008. Her $1 million portfolio plummets to $700,000. But she still needs to live, so she's forced to withdraw the same $40,000 for her living expenses. Her portfolio is now down to just $660,000. Let's just pause and let that sink in. In 1 year, because of nothing but bad timing, Jane 2's nest egg has been hammered by over a third. But the real damage, the detonation of the bomb, happens next. Let's say the market comes roaring back the following year with a 30% gain. Jane 1, who started strong, sees her $1,060,000 grow to over $1.37 million. She's in an incredible position. Jane 2, however, starts the year with only $660,000. A 30% gain on that much smaller amount only brings her back up to $858,000. Even with a powerful market recovery, she's still way below where she started. She is permanently locked in her losses because she was forced to sell her assets at their lowest point just to get by. She had to sell more shares at depressed prices to get her $40,000. And those shares are now gone forever. They can't participate in the recovery. This isn't just a theory. Studies have shown that an investor who retires into a bear market could run out of money 10 to 15 years sooner than someone with the exact same portfolio who just had better luck with their timing. A lifetime of smart investment decisions can be wiped out by 2 or 3 bad years at the wrong time. This is sequence risk, and it's the primary fuse on the 401k time bomb. How to disarm this fuse? You can't control the market, but you can control your strategy. The key is to avoid selling your growth assets like stocks when the market is down. So how do you do that? You build a buffer. This is often called a bucket strategy or creating a war chest. The idea is to have 1 to 3 years worth of your living expenses set aside in safe, stable, liquid accounts. This could be cash, a high yield savings account, or short term bonds. This is your income bucket. When the market is doing well, you live off your normal withdrawals and maybe even skim some gains to refill your cash bucket. But when a bear market hits, like it did for Jane 2, you stop taking withdrawals from your stock portfolio entirely. Instead, you live off the money in your cash bucket. This gives your investments time to recover without you being forced to sell at the worst possible moment. This single strategy is one of the most powerful ways to diffuse sequence of returns risk. It turns a crisis into an inconvenience. The second fuse is way more sneaky. It doesn't explode, it corrodes. It's the silent, relentless force of inflation. According to recent studies, inflation is the number one financial worry among retirees, even more than healthcare costs. And for good reason. During your working years, inflation is an annoyance, but it's usually masked by pay raises your income tends to grow along with or faster than the cost of living. But once you retire, you're living on a mostly fixed income. You might be thinking, but Social Security has cost of living adjustments. And you're right, it does. The problem is, those adjustments often don't keep up with the real world price hikes on things retirees spend the most money on. Think about it, a 3% average inflation rate, which is pretty normal historically, will cause prices to double in about 24 years. If you retire at 65, your retirement could easily last that long. The $5,000 a month that feels comfortable today will only have the purchasing power of $2,500 by the time you're 89. Your nest egg is effectively being cut in half, not by market losses, but by the loss of your money's buying power. The problem gets really serious with healthcare. Healthcare costs consistently rise faster than the general rate of inflation. A 2025 survey from Global Atlantic showed that a staggering 90% of retirees are worried about rising healthcare costs. Some research suggests that Americans may spend over a decade in poor health late in life, a time when medical bills can explode. Your 401k balance might look great on paper, but that number is a mirage if it's not actively growing faster than your actual costs are rising. A portfolio that's too safe, just sitting in cash or low yielding bonds, isn't safe at all. It's a guaranteed loss of purchasing power. How to disarm this fuse. Disarming the inflation fuse means shifting your mindset. Your goal in retirement isn't just to preserve your money, it's to grow your purchasing power. Your portfolio still has to work for you. First, this means keeping a healthy amount in growth assets like stocks. It might feel weird to hold stocks in retirement, but they are one of the few things that have historically beaten inflation over the long haul. The trick is balancing this with the sequence risk we just talked about. Second, look into specific inflation hedging assets. Think about things like treasury inflation protected securities, TIPS, real estate, and even certain commodities. These are designed to do well when inflation is high, acting as a shock absorber for your portfolio. Finally, you can build your own raise into your retirement plan. This means creating an income stream that's designed to increase a little bit each year. Some annuities offer this feature, or a well-managed portfolio can be structured to provide a growing stream of income. The bottom line is you simply can't ignore inflation. You have to plan for it, or it will silently take your financial security apart. If you're getting value out of this and starting to see your 401k in a new light, do me a quick favor and hit that subscribe button. My goal on this channel is to pull back the curtain on how the financial world really works and give you the tools you need to build real, lasting wealth. We're about to dive into two more hidden dangers, so you're not going to want to miss it. The third fuse is one that most people with a 401k don't even know exists, or they massively underestimate how destructive it is. It's the parasite of fees. An AARP survey found that over 70% of 401k participants thought they paid no fees at all. I can't blame them for thinking that, but it's tragically wrong. Fees in a 401k come in a few flavors: administrative fees, record keeping fees, and the biggest one, investment fees, also known as expense ratios. These are sliced off your balance every single day, and because you never write a check for them, they're basically invisible. You might look at your plan, see an expense ratio of 1% or 1.5%, and think, what's the big deal? If the market is returning 8%, who cares about 1%? This is the most expensive mistake you can make. That 1% isn't a one-time charge. It's an annual charge on your entire balance. And the real cost isn't just the fee itself. It's the lost growth on that fee for the rest of your life. It's a concept called fee drag, and it compounds against you just as powerfully as interest compounds for you. Let's look at the numbers because they're staggering. The US Department of Labor ran an analysis on this. They compared two people starting with $25,000 who invested for 35 years, earning 7% a year. The only difference? Their fees. One paid 0.5% a year and the other paid 1.5%. After 35 years, the investor paying 0.5% in fees ended up with about $227,000. The investor paying 1.5% in fees, they ended up with only $163,000. That's a $64,000 difference. A seemingly tiny 1% annual fee ate up nearly 28% of their final nest egg over a full career. This can add up to hundreds of thousands of dollars in lost savings. Think of it like trying to run a race with a parachute strapped to your back. No matter how fast you run, that constant drag is slowing you down, guaranteeing you'll finish far behind your potential. How to disarm this fuse? This is one of the easiest fuses to disarm because you're almost entirely in control. You just need to become a fee detective. First, log into your 401k and find the fee disclosure document. It might be called a 40405 disclosure. They often bury it and write it in dense legal language, but you're looking for the expense ratio of each fund you own. Second, check your fees. What's a good fee? For a broad market index fund like an S&P 500 fund, you should be paying well under 0.1%. Some are just fractions of a percent. For actively managed funds, fees will be higher, but anything over 1% should make you very suspicious. If your plan is full of funds charging 1.5% or 2%, you are paying way too much. Third, take action. Look for the lowest cost, most diversified index funds in your plan. Just switching from high cost funds to low cost ones can save you tens or even hundreds of thousands of dollars. If your plan just doesn't offer good low cost options, you can talk to your HR department about finding a better plan provider. They have a duty to act in your best interest, and that includes providing a plan with reasonable fees. Don't let this silent parasite eat your future. The final fuse is a psychological trap that millions of savers fall into. You log into your account, you see a balance of $1 million, and you think, I'm a millionaire. You feel secure, you feel wealthy, but you're not a millionaire. You're the manager of $1 million account that you share with a silent and very patient business partner, the government. This is the tax mirage. Every dollar in your traditional 401k has never been taxed. It went in pre-tax, it grew tax deferred, and when you take it out, it will be taxed as ordinary income at whatever your tax rate is in retirement. That $1 million balance isn't your real balance. Your real balance is $1 million minus your future tax liability. Let's say you plan to live on $80,000 a year, and that puts you in a 22% federal and 5% state tax bracket. Your total tax rate is 27%. That means every withdrawal you make is instantly cut by over a quarter. To get $80,000 in spendable cash, you actually need to pull about $110,000 from your account. That $1 million you thought you had? It's really more like $730,000 in after-tax money. That's over $250,000 that was never really yours. This is a huge shock for retirees who planned their entire future around that top-line number, and it could get worse. We are currently in a period of relatively low income tax rates by historical standards. Given the level of national debt, it's very likely that tax rates will go up in the future. The tax rate you're deferring today could be much lower than the rate you'll eventually pay on withdrawals 10, 20, or 30 years from now. You've unknowingly made a bet that your tax rate in retirement will be lower than it is today. A bet that could easily be wrong. How to disarm this fuse? The solution here is tax diversification. You wouldn't put all your money in one stock, so why would you put all of it in one tax bucket? The goal is to have money in 3 different types of accounts for retirement. Tax deferred, this is your traditional 401k or IRA. You pay taxes when the money comes out. Tax-free, this is the golden goose. This is money in a Roth 401k or Roth IRA. You contribute with after-tax dollars, but it grows completely tax-free, and all qualified withdrawals in retirement are 100% tax-free taxable. This is a regular brokerage account. You pay capital gains taxes on the growth when you sell. Having money in all 3 gives you incredible flexibility in retirement. In a year where you need more income and it would push you into a higher tax bracket, you can pull from your Roth account tax-free. In a year where your income needs are lower, you might pull from your traditional 401k. This control lets you actively manage your tax bill every single year in retirement, potentially saving you a fortune. If you have a Roth 401k at work, use it, especially if you're in a lower tax bracket now than you think you'll be later. If you don't, contribute to a Roth IRA and think about doing strategic Roth conversions, paying the tax now on a portion of your traditional 401k to move it into a Roth account, especially in low-income years or during market dips. Building that tax-free bucket is one of the most important things you can do for your financial future. The 401k is a powerful tool, but it's not the foolproof path to security that so many people believe. It's a system with hidden flaws, a ticking time bomb armed with four fuses, sequence of returns risk, the silent erosion of inflation, the parasitic drag of hidden fees, and the deceptive tax mirage. But the point of this isn't to scare you, it's to empower you. Because knowledge is how you disarm this bomb. By understanding these risks, you can take back control. You can build a cash buffer to protect yourself from bad timing. You can structure your portfolio to beat inflation. You can hunt down and get rid of high fees. And you can diversify your money to shield it from future tax hikes. Your 401k doesn't have to be a ticking time bomb. It can be what it was always meant to be, a fortress of financial security. You've worked too hard for too long to let these hidden dangers wreck your retirement. Now you have the blueprint. Go and disarm the bomb. Thanks for watching, and don't forget to subscribe for more insights to help you master your money.